Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC.
I want to welcome you into, and thank you so much for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates with Nolan Baker. 419-794-3030 is the phone number. Once again, that's 419-794-3030, online, arhq.com. My name is Chris Wan. Today on the show, we have the unspoken truths about retiring early, and if you suffer from the fear of missing that paycheck when you retire, we might have an answer. Also, why we shouldn't get our financial advice from TikTok. All this and more. But first, let me check in with the man himself. Nolan, glad to be with you as always. How are you, sir?
I'm doing fantastic. Yeah, it's wonderful. It's springtime. We're starting to get a little bit of that taste of some warmer weather. So I think good things are to come, and looking forward to spending some of that good weather outside, getting the golf clubs out. So not too much longer.
No, definitely. It's around the corner. A lot of things to be excited about. Maybe retirement's around the corner for you, something to be excited about. But also, knowing that, yes, in the springtime, there's also those rainy days and same sort of thing in your retirement. It's not always going to be, 70, 75 and perfect out there. So you want to have a plan in place. That's what we want to get you thinking about. And also, hopefully offer up a little bit of relief from that worry you may have. So when you're ready to speak with the team and start planning that process, 419-794-3030. Let's start with this. If you thought cyber currency was fading, think again. Bitcoin has been setting record highs. It actually hit $69,000 about a week ago. And I read an article that said, investing in digital assets is not going away, and it should actually be considered by financial advisors. So, Nolan, I have to ask, does cryptocurrency belong in a retirement portfolio? And if so, how much?
Well, when you think about how much cryptocurrency should I have in my portfolio, it really kind of depends upon your overall appetite or level of comfort with risk. I would consider a cryptocurrency to be a 9 out of 10 level risk, which means it's going to have a lot of volatility, but, also a lot of opportunity. And, maybe if I backed up a minute, shared a story with you, for those of you who've been listening, you may know in the past that I've shared a little bit that my oldest son, Andrew, he's been actively involved in cryptocurrency probably a little over a year now. What he did is he had got a graphics card, and he has these graphics cards set up as ultimately supercomputers, and what they're doing is they're performing a lot of the transactions for some of the digital assets and currency that's out there. And by doing so, what he does is he gets paid a little bit of some income by having these computers run those cryptocurrencies. It's called digital mining. Could be, a great way for a 20-year-old as Andrew to make some passive income. But what he's also been doing is he's been taking that passive income, and he's also been using that to go out and purchase the digital currencies that are available out there. In this example, Bitcoin being, one of the largest known, the biggest one that set that record, as you pointed out, at $69,000 a coin back in March of 2024. But there are other cryptocurrencies that are out there, Ethereum, there's quite a few different ones to pick from. And so when you look at this, I would say that there absolutely is an opportunity for people to get involved in the cryptocurrency in one capacity or another. So when we look at this, if you're wondering, should I have a cryptocurrency, digital assets in my portfolio, or companies who benefit from that, and if your financial advisor is not talking to you about it, I would say we should have a conversation and talk about why maybe you should have anywhere from 1% to 3%. Again, dependent upon what your level is and comfort level is of risk, invested in some type of digital asset or company that would benefit that. Because I do think that it can now be a place in the portfolio, because what you had is the Securities and Exchange Commission gave approval to cryptocurrency exchange traded funds by a major of the financial houses in January of 2024. And so what that should do is that should make financial advisors and their firm willing to speak more about investing in crypto shortly. And if we look at other professionals that are out there, like Rick Edelman as an example, he predicts that independent financial professionals are going to invest, roughly $150 billion in spot Bitcoin ETFs over the next 2 to 3 years. And so if we look at the markets and we think about the markets, the stock and bond market are an all-day, everyday auction when they're open. So the more people to show up to buy, the higher the price goes, and the more people show up to sell, the lower the price goes. So now that financial professionals like my firm and other firms have the ability to start talking about these cryptocurrency ETFs, you could have another big wave of buyers moving into the market like Rick Edelman is predicting. You also have Jeffrey Jansen. He's a wealth advisor, also talks about, again, somewhere having that 1 to 3% type allocation in a portfolio. Talking about the philosophy of it's a good idea to walk before you run, getting prepared mentally, again, for some of the volatility. If I look at Andrew's experiences, in the early on part of his crypto mining, things ultimately were going great. If I looked at the year of 2020, you had a lot of the crypto prices were, dramatically dropping in prices. And now, what we see here in the overall past 6 to 8 or 9 months, crypto prices have also dramatically come back up. So it is, somewhat of that big roller coaster ride, which is why, again, you've got to be careful with the amount that you put inside of it. Where you can also seek some other opportunities if you're not looking at actually owning some of the ETFs that are cryptocurrency is you want to look at some of the companies that are out there like the semiconductors. So, with Andrew and his computers, he's got 36 semiconductor that are performing these transactions in his supercomputers. Look at the things that are like the publicly traded companies. So there's some platforms out there of companies that are publicly traded that allow you to exchange these currencies. Those could be ones that you could take a look at. And again, the SEC approval list of the ETFs that now allow you to invest in those digital assets is another area. When you look at some of these publicly traded ETFs, you'd want to pay attention to understanding exactly what it is that they're investing into. So some companies are invested into not the digital assets. Some companies are invested into the miners or the graphic card makers or the people that are behind the scenes. Some of these newer ETFs, now that they're allowed to, are going to actually get involved in the cryptocurrency. Some of the strategies will diversify your money among multiple different currencies. So if you didn't want to have all of your money in one digital asset, you maybe wanted to diversify it. That can be one of the advantages of an ETF. It gets you kind of that diversification that's outside of there. So I would say, folks, bottom line is to know how much you should invest in your portfolio. It's, first of all, to get educated. If you have heard maybe a cocktail discussion about cryptocurrency and you wanted to know, how does this apply to my situation? What really is crypto? What are the different options that are available to me in your portfolio? I would say give our office a call. We can sit down, spend some time, educate you a little bit about it, and then show you the ins and outs and stress test the portfolio. So if you want to find out how this can be part of your portfolio, give us a call at the office. We're happy to walk you through that approach. But I would say, yes, it's worth at least becoming educated about it. And so even if it's not right for you, the pros and cons of the strategy that was, again, just recently approved by the Securities and Exchange Commission as something that ETFs can be offered by most of the financial houses in my industry.
As Nolan said earlier, this isn't a silver bullet thing where you need to put all of your money in it. Not by a long shot. There is a good bit of risk still involved, but it could be a valuable part of your retirement strategy, your investment portfolio. So to get more education about it, and then see how it could work for you, just schedule a time to speak with the team at America's Retirement Headquarters. You can give a call, 419-794-3030, or you can always go to the website as well, schedule a time, and find out more about the team at arhq.com. The world of TikTok has given us everything from food challenges, teaching us how to dance, to crazy, sometimes dangerous stunts. There's also plenty of videos on there dispensing money tips. Nolan, I've run across a few that a list of ones to avoid. What do you think of these? And can you add any others that you may have seen online?
Well, I guess there definitely is an explosion of advice that you get on social media. I probably should watch some more of those dance videos because I still have 2 left feet, but a friend of mine, we go and we meet up at one of the local gyms, and we like to work out a couple days a week together. And, oftentimes we'll start off our workout on the treadmill. And that actually is oftentimes the topic of conversation that we'll have on the treadmill. He in particular likes to watch some different videos on TikTok, and he'll ultimately kind of share those different videos with me and say, hey, what do you think about this? And, should we get in on this, or what about this? And, one of the things that I would say is when you look at the advice that you can get from social media, there is some social media financial advice to avoid. So as an example, I am biased. I mean, here I am on social media. I'm also on Toledo's largest talk station, 1370 WSPD, but I've been on the radio giving advice for 20 plus years. I've been licensed in the financial services industry for 30 years. So here's what I want you to do is when you get that social media advice, number one is I want you to make sure that you understand what is the methodology and the philosophy that's being used in your current investment portfolio. One of the great things about the military and joining the Marine Corps is the Marine Corps taught me discipline. And you want to stick to your discipline. So, those short little bursts of news articles or media attention is designed to kind of get in your face fast. And they're going to drive on your emotions of fear and greed. And those two decisions can be a painful lesson. By that, again, I mean, stick with your discipline when it comes to investing. So I'll give you an example of a company that he had sent over to me and said, hey, take a look at this company. I saw this video there on TikTok, thought the company was going to explode. There's 5 key disciplines that I have here at Retirement Guys Formula when it comes to investing. Number one, we like to look at companies that have high cash positions. Number two, we like to look at companies that have low debt. Number three, we like to look at companies that have high profit margins. Number four, we like to look at companies that are needed on a daily basis. And or number five, we like to look at companies that have a competitive advantage. So one of the companies that he sent over to me, I was going through those 5 criteria. And when I looked on the financial statement, this company was really about 3 months away from ultimately being bankrupt. They had really no cash on hand. So I answered him back and I said, just simply based upon the financial position of the company, I would not invest my own money or anybody's money in this company. Maybe it's going to be a big home run, but the problem is if they don't raise some money pretty quick, it could be a disaster. There's also a lot of news that you get in there. And today, with anybody who has a camera or has a phone, they're able to create a TikTok video. So you want to understand the background of the person that's giving you advice. You can get advice off the internet from somebody who has zero financial experience at all. They might have some type of hot stock tip. They might really, again, not have any experience. More importantly, they don't know your individual situation, and looking at your individual situation and figuring out how to apply to your individual situation is probably one of the most important things. The other thing that I would say is a lot of times people will forward me these videos and say, hey, take a look at this. It's oftentimes talking about maybe the collapse of the United States, maybe the collapse of the US dollar or the currency. And I say, well, flash forward to the end of the video. And at the end of the video, find out what they're selling.
Yeah.
So if they're talking about the end of the world coming for the U.S. currency, and oh, by the way, we sell gold. Well, now you know the reason why they're saying that. If they're talking about getting out of the stock market and why buying an annuity is the best thing ever, and oh, by the way, they sell annuities. Then you know what they're doing. If they talk about annuities are the worst thing ever and put all of your money in the stock market, and by the way, they'll charge you to manage your portfolio in the stock market, again, you know what they're doing. So you have to look at the end. I mean, even our videos as a licensed financial professional, my end goal is to get together with people and educate them into making smart financial decisions based upon their situation. And certainly I get compensated for doing that, but it's only after I really understand what their unique situation is and not just give blanket advice that says everybody should do this. What you want to remember is that there is no Swiss Army knife of investing, meaning there's not one right financial product in every situation. Everybody's situation's a little bit different. So again, take a look at what they're selling.
I'll have to admit, there's a few times I've been on, TikTok or, various social media, and I find recipes that I like for food, things like that. When it comes to investing, here's the truth of it, and you mentioned it, Nolan. There's no accountability really at the end of the day. If they give bad information, if they're bad actors on there's no fallout for it. Longtime listeners and viewers of the program will know, there's disclaimers at the back because there is liability, there's credibility backed by what you say, and so it's important to keep that in mind as well. If it sounds too good to be true, you just want a little more information. Nolan has offered up the services of the team at America's Retirement Headquarters. All you need to do to reach out is give a call, 419-794-3030. You can also drop them a line on the website, and that is arhq.com. While perhaps not a household name like some TikTok stars, Jordan Belfort was the focus of the movie The Wolf of Wall Street. After 22 months in prison, he is out, and he wrote a book called The Wolf of Investing. Belfort is very critical of the fees that big financial firms charge. During an interview with Tucker Carlson, he told the story of Jack Bogle from Vanguard, who went to war on fees.
When he started Vanguard, Wall Street went out on the ultimate smear campaign for like a decade, suppressing everything about index funds, saying it's the stupidest thing. Who wants to be average? Dreyfus, which is a huge mutual fund company, said, no fees, no way. So for many, many years, Vanguard languished and was suppressed, right? It finally got traction after the crash in 87. For the first time, all of a sudden, the mirage evaporated when everyone lost a lot of money. And for the first time, it suddenly became a mass exodus out of these, sort of high expense mutual funds, right? And Bogle saved the public probably a few $100 billion by now in fees. Mutual funds were ripping people's eyeballs out forever.
Now, I know a fee analysis is something that the Retirement Guys formula does. When you do that kind of analysis for your clients, what are some of the common things that you find?
We love doing fee analysis. Again, with this time of year, it is the time at home where I'm going to start changing out my closet and go from the winter wardrobe to the spring wardrobe.
Mm-hmm.
And, one of the best things ever is when you put a spring jacket on that you haven't had in a year and you put your hand in your pocket and you pull out $20.
The best.
I don't know if you've ever had that.
Love it.
It's just fantastic. And for me, it's like helping people go through and find those, hidden dollars that they forgot all about or were not aware of when they look at their portfolio. So the first thing I would say is if you look at Jordan and his, comments that he made here, again, the person that the movie The Wolf of Wall Street made famous about is one thing I would say is be cautious about getting advice from somebody who spent time in prison, right?
Sure.
That's one observation. He's talking about avoiding getting ripped off. But I guess, again, if you want to listen to avoid getting ripped off, you might want to listen to somebody who did rip off a lot of people and spent time in prison for doing so. And the fees aren't necessarily a ripoff, meaning that the cheapest isn't always the best, but cost absolutely counts. And it's important to understand, when you do an analysis, are you getting enough value in exchange for what the fee is? I had somebody who had recently come into our office, and that this particular lady was probably about 5 to 7 years away from retirement. She's not married and has no kids. And, her primary concern is like most retirees today, not wanting to outlive their income. And, I get that with single, no kids. She's just got to take care of her money. And so we spent some time going through a planning process and looking at what her minimum monthly income needs were and what her ideal income needs were. And when we looked at the portfolio, she had purchased what is called a variable annuity in the past. And the variable annuity, the goal of that was to provide more predictable income in retirement time. The challenge is, when I did the analysis of it, not only did I think the variable annuity cost structure was really high in comparison to some other alternatives out there, the income value that was offered to her was not nearly as close to what it could be in today's environment. So there's like good and bad annuities, just like there's good and bad stocks or good and bad bonds. And it's a matter of understanding and knowing what you have and what you own. We do have an event that we're having here coming up in Toledo, talking about the truth about annuities. If you go to arhq.com and you click on the events tab, I encourage you to sign up for our upcoming event, especially if you have an annuity that is a couple of years old, because it may be worthwhile to do an independent review of that annuity when you're looking at the cost structure, as well as what you're looking at in determining what it can provide for you. When I did an analysis of this particular lady's annuity, what I had found is that because interest rates went up so fast, so far in the last year, she could take only about 60% of her account and put it into a different annuity account and get the same level of income to provide the minimum monthly income needs, thus freeing up about 40% of the money that allowed us to do other things, maybe even more conscious, lower cost type investment approaches. But when you're breaking down fees and when I'm doing a fee analysis for a client, this is what you want to write down, the things that you want to know. First of all, you want to know about, number one, management fees. These are the fees that are charged by like mutual funds, exchange traded funds, management accounts for the ongoing management of the portfolio. Those management fees, when we do the portfolio analysis, these are the ones that are oftentimes a little bit harder for people to see because they're typically buried in. But in that fee analysis that you talked about, Chris, this is something that we can show you exactly what those management fees are. Number two is you want to look at expense ratios. The expense ratios, they represent the annual operating expense of the mutual fund or the ETF. And again, they're usually a percentage of the average net assets. They cover things like administrative costs, management fees, other expenses associated with kind of running the fund. They can be more expensive for more actively traded funds, and they can be less expensive for more index type strategies. Number three is sales loads. And so sales loads are fees that are charged when you have the buying or selling of certain mutual funds. And these are usually a percentage of the transaction. So you have what's typically referred to as like a Class A mutual fund would normally be what we consider to be a front-end load that's deducted from the initial investment. Things like oftentimes called Class B funds or back-end loads. They're charged if you redeem your shares within a set period of time. And some funds have level loads, which can be assessed on an annual basis. Number four is you have advisory fees. These are the fees that are charged by financial advisors for providing investment advice and portfolio investment management. Advisory fees are usually structured as a percentage of the total of the assets under management. It sometimes can be also a flat fee. It could also be quoted in terms of an hourly fee. It depends upon the advisor's fee structure. Usually these fees are fees that you see would be debited out of your investment account. So the nice thing is you can see those fees and expenses printed on the statement, and or you can ask your investment advisor for a copy of what is called its ADV. And inside of this ADV will outline the different portfolio management services that are offered, as well as what the typical range of advisory fees are. Number five is trading cost. Trading costs, have gotten a lot better, in my opinion, over the years. In the last 30 years, there's even trading expenses going down. But what you have here is when, buying and selling of a stock, bond, or other security through a brokerage account, investors are going to sometimes incur different types of trading fees. And these are the fees that are based upon the broker, the volume of the trade that's executed, and what type of investment it is. So sometimes things like stocks could be a lower cost trade than, say, an option or some type of limited partnership, or something that's less liquid could have higher fees. Number six, you have custodial fees, and custodial fees are the fees that are charged by brokerage firms when financial institutions for holding and kind of safeguarding your investment account. These fees are typically charged on an annual basis, and they can kind of vary, again, depending upon your investment size. Number seven, account maintenance fees. Some investment accounts such as IRAs or 401ks, those type of plans can have account maintenance charges charged by the financial institution or the plan administrator. A lot of these times, account maintenance fees can be kind of, minimal. Those can be expenses that they might charge a flat fee. And number eight, like I talked about, is in annuities. Some different annuities have fees and expenses associated with it. Variable annuities, in my opinion, tend to be one of the most expensive type that are out there because you have not only sub-account fees, you could have rider fees and sub-account fees, and those can add up to be quite a bit. Sometimes when you have fixed and or fixed index annuities, some are no fee and other ones have fees depending upon, what the parameter is of the account. So if you haven't had a portfolio x-ray, as you can see, I just rattled off 8 different types of fees. And some of those fees are probably adding value to you. And some of those fees, maybe you can eliminate those fees to keep more of your hard-earned money in your pocket. So if you want to get a second opinion, or if you're not sure what you're paying, pick up the phone. Again, if you are listening to the show, just tell them that you listen to America's Retirement Radio here and listen to the show, and you want to get to that portfolio x-ray to understand your fees and expenses, and we'll provide you that printout, absolutely no cost, and walk you through what your total fees and expenses are.
Just as a way of saying thank you for joining us here on the show, that number is 419-794-3030. There's a decent chance that you may be paying more in fees than that $25 thing that you see on the bottom of that first page. There are things buried in there. Having this analysis done can shine a little bit more light on that, and then perhaps explore other options out there if it better suits you. 419-794-3030, or you can go to the website and find out more about that upcoming event at arhq.com. Back in 2015, Oprah Winfrey made headlines when she bought a 10% stake in Weight Watchers and was appointed to the company's board of directors. But Winfrey says she's stepping down in May after revealing, well, she took a weight loss drug. What about her $18 million in Weight Watchers stock? She's donating it all to charity, and in the process, she's actually going to get a big tax break. That is definitely turning lemons into lemonade. What are some other tax strategies that could do the same, Nolan?
Well, there's 25 of them that we go through on our tax savers checklist, and that ultimately results in creating a 2024 tax roadmap. So I know many of you listeners right now are gathering your paperwork, getting things ready. Maybe you've already met with your accountant and you're saying, I'm done for the year, but you're done recording history when you get your taxes done. What we're talking about here is we're talking about, taking a proactive approach to trying to minimize the taxes that you pay in 2024 for the future, and ultimately for, what money is left to your loved ones. And the way to do that is to sit down with me and go through the 25-point tax savers checklist, and also get a 2024 tax roadmap. So if you're a listener to the podcast, the YouTube channel, or on WSPD radio, and you want to take advantage of this, just reach out to us. Again, arhq.com is the website, or give me a call at 419-794-3030 and say, Nolan, I want my 2024 tax roadmap because I want to go through that checklist, because it is not your constitutional duty to pay one more dollar to the government than what is called your fair share. And so looking at these strategies can make a big, big difference. And so if I go through and I take a look at them, and there's a couple of them that jump out to me. Number one would be looking at, a strategy known as Roth conversions. So last week I had met with a couple that were recently retired. These retirees, they actually inherited some decent money from a loved one, and their family left them a portion of money that was considered after tax, meaning that they could use that money to dip into now that they're retired and use it to fund their lifestyle. Besides reporting maybe a little bit of profits or a little bit of interest and dividend income that investment account generated, it wasn't really a big tax hit to take money out of that account. So in essence, what they were doing is they were living off of Social Security and a little bit of taxable reportable income. And what I had said to them is I said, well, if you look over here, your big nest egg of money that you have is in these tax deferred retirement accounts. And with these tax deferred retirement accounts, you're going to have to pay taxes at some point in the future when you begin to take things like required minimum distributions, or when you take a withdrawal out. And that is when you would pay the taxes at what the future tax rate is. And based upon the out-of-control spending that the government has had, I believe that tax rates will be significantly higher in the future. And so what you could do is you could look at a strategy called a Roth conversion. And with a Roth conversion, what you're doing is you're taking a portion of that tax-deferred account, converting it over. In the year that you convert it over, that's when the taxes are paid on that account, moving it over into what could potentially be a tax-free Roth IRA. Again, to meet the definition of that, generally speaking, you have to have the account open for 5 years or longer and be over 59 before you access your profits. But in exchange for that, that money then continues to go tax-free for you and your family in the future. And so an incredible strategy to help keep the government away from you and your money. If you haven't had a 2024 tax Roth conversion analysis done, that is part of what we do in that tax roadmap. So again, that's something that if you want to take advantage of how to pay taxes and the minimum amount now and in the future, that tax roadmap is right for you. Number 3, I mentioned the word required minimum distribution. So some of you that are listening are at the age where you're forced to take money out of your retirement account in what is known RMDs. Those RMDs have you take money out of your account. There's 2 things that I want you to look at. Number 1 is if you are, charitable minded. So if you go to church and you tithe, or if there's a charitable organization that is important to you that you donate money to, you could be much better off making that donation of your required minimum distribution directly to the charity, because if structured correctly, not only could it satisfy the required minimum distribution, that RMD could stay off of your personal tax return, thus lowering your individual tax rate. And number three is, a charity typically doesn't pay taxes on money that they receive, so that gives 100% of the money to go to work. The other thing to think about is if you're a required minimum distribution age and maybe you have other thoughts about charities and donations, or maybe your RMD is a little bit larger than what you want to give, but maybe you're looking at an investment that you love. So maybe your retirement account is invested in some stock that's been important to you over your lifetime. You don't really want to liquidate that stock to take it out. What you can do is you can take a look at getting your RMD done by not liquidating the shares, but having the shares transferred out of your retirement account. You move them over into individual account, and especially do that with shares that you think are likely to be higher in price in the future. A terrible time to take out and sell stocks is when the market's temporarily down and you expect those accounts to be worth more in the future. So, those in-kind RMD distributions or using charitable distributions is something else, again, that we can talk about as far as the 25-point checklist on that tax savers checklist. And the third one is looking at tax loss harvesting. So, tax loss harvesting is looking at your non-retirement accounts and doing that towards the end of the year. What it's looking at is it's looking at the investments that were realized, that were sold, that you either made a profit or had a loss on, and kind of comparing that together. What you don't want to do is you don't want to get a surprise after the year is over, because once December 31st happens, you're kind of locked into your tax loss reporting and reporting what your capital gains are going to be for that year. And tax loss harvesting, if done correctly, could help offset those gains, potentially lowering your capital gains income taxes. And in certain situations, it could make sense, if there's some losers in there, getting you in a situation where you could have, up to a $3,000 deduction. But there again, this is an area where I'm not a CPA. I work hand in hand with a CPA. I'm happy to work with you or your CPA in developing smart tax strategies. This is an area where the decisions that you make with your finances impact your taxes. So why not have all three of the people, together making those smart decisions? The CPA or accountant, the financial advisor, and the client. That's exactly what we can do. And the first step is an easy step. It's picking up the phone, scheduling a time where we can go through the tax saver checklist. Let's talk about the 25 items on that checklist, see which of them apply to you. Take that information, turn it into a 2024 tax roadmap, and then we'll get together and have a conversation with your accountant, or you can, talk to an accountant that we can recommend for you, and have somebody that is going to be the one preparing the taxes confirm that those big tax saving strategies might be the right approach for you.
Obviously, make sure that you pay your taxes for the coming year, in April, but also go ahead and start developing that plan, not just relying on history and paying back on that, but also develop a plan to mitigate and minimize the amount that you have to pay in the future. That starts with having that tax roadmap done. The team at America's Retirement Headquarters, happy to do that for you. Just reach out and give a call, schedule a time, and tell them you'd like that tax roadmap. 419-794-3030. You can also drop them a line on the website, and that is arhq.com. The Federal Reserve meets again this coming week to talk about interest rates, and Wall Street is betting a rate cut won't happen. Here's market analyst Pete Najarian on Fox Business.
So many people at the start of this year were predicting that there was going to be 6 or more rate cuts. I never agreed with that commentary, but it looks like we're going to probably, as we go through the year, if things kind of go through the way expected, we're probably going to see this year about 2 cuts, maybe, but the rest are going to be pauses. And I think this next one's going to be a pause as well.
Now, if he's right, then the Fed is carrying through on its pledge of higher interest rates for longer. If that is the case, if that is true, is it a bad time for people to invest in fixed income investments?
Well, first of all, what I wanted to say is thank you to a lot of our listeners that came out and joined us here just recently at our economic summit. So every 6 months we get up and kind of do a little of our State of the Union address, and I know we had a lot of our listeners come out and join us. So appreciate you being here. And if you were an attendee, you got to hear firsthand, kind of this exact topic that we talk about. And, as we look at it here in March of 2024, what we have is we have the major market indexes, overall, be it the S&P, the Dow, the NASDAQ, at or near record level highs. Not all index are at record level highs, but you also have, even overseas, like in Japan, their index is near a 32 level high. So it might be easy for one person to say, hey, my fixed income investment isn't really performing as good as my stock portfolio, so I should get out of my fixed income investment and go over and add more to the stock portfolio. In fact, when I go to Yahoo Finances and I look at a comparison chart of, say, the S&P 500 index versus the aggregate bond index, in the last year, there's almost about a 30% difference between the stock market and the bond market index. And so one might believe, to get into the market, the dangerous thing about that is you'd be selling low and buying high. And, we caution a little bit about the interest rate risk that bonds had before interest rates went up. But now that interest rates have come up a lot, and the Federal Reserve, although they're not lowering interest rates right now, if you look at it, there could be some real value into adding either bonds or fixed income back into part of a portfolio. And the reason why is because interest rates went up, the yield becomes much more attractive in some of the fixed income market space. If you look at the price valuation, where you have stocks at record level highs, what you have is you have a bond market that really hasn't recovered from the major drops that it took in 2022. So if you added money into the bond space, you're going to be able to purchase something that's not back to its all-time high. So again, when it comes to investing, you want to buy low, sell high, not chase winners and be the last one left at the party. If, bonds aren't your thing, then I would also say there's a lot of other fixed alternatives that you could look at from diversification, meaning that whether it's a money market account, the FDIC insured bank CDs, even the rates that are offered by the fixed annuity companies, these are the types of rates that you want to be taking a look at and adding into your portfolio. My fear is if you take and you pull out of your fixed income investments and you put them into your stock market investments, you're going to get your risk level too high. And as we know, time and time again, at some point, the market won't always be at record level highs. So the last thing you want to do is buy high, get beat up in the market, and then all of a sudden, be in a situation where your risk level is too high. If you want to know kind of what should be the right allocation for you based upon what your investment portfolio is, we have this software where we can help you develop what is called an investment policy statement. And I'm biased, but I absolutely love it. It's not ours. It's a third-party software. And so what we do is we go through asking you a series of questions like, do you like this investment better or this one or that one? So it's kind of like going to the eye doctor's test. And the goal is to get you 20/20 clarity with what your goals are with your investment portfolio and coming up with what your individual risk number is. And when we answer that series of questions, based upon how you answer them, it's typically going to tell you you're, let's say, a 35 level risk. That's what you're comfortable with. And again, we're going to measure risk anywhere from 0 to 100. And if your risk comes back at 35, the next thing that we're going to do is we're going to take your portfolio and we'll put your portfolio in there and we'll see what the risk number is with your current portfolio. I did this the other day for a couple that had come in, and it showed that they had a risk score of 75. Now, in this case, the husband felt comfortable being fairly aggressive, and the wife, I think, was fairly shocked when she looked at the amount of money that the portfolio could go down because it was all at risk. And now we're working on giving them some advice and feedback on how to kind of get the best of both worlds, meaning have a portion of the portfolio that gives the husband the growth potential that he's looking for, but provide the safety. And part of the ways to provide the safety is some of these fixed income investments that are out there, and it can help reduce the risk, because while the market is an all-time high, now is the time to understand what your risk is, and don't chase the hot investment. That could be a dangerous move to make in this environment right now. So if you want an independent portfolio analysis, you want to find out what is your risk level, and you want to know what your portfolio risk level is, give us a call. I'd be happy to get together and provide you your investment policy statement.
It's easy to say that you're comfortable with risk when the markets are soaring along. People did that for, the better part of a decade from 2009 up until, right around 2019, 2020, saying that they were comfortable with risk because the markets seemed to do nothing but go up. We've had a reminder as of late that is not the case. And so it is a pretty good time, especially as Nolan pointed out there, with the markets being as high as they are right now, to really dial back and say, how comfortable am I with risk in actuality? You may find out that you are taking on more than you're comfortable with, but you don't know until you sit down and you have that risk analysis done. The team at America's Retirement Headquarters, one of the many things they can do for you. You just have to take that first step and reach out to them, 419-794-3030. Now, when many people think about retirement, they look forward to the easy days filled with leisurely activities, lots of naps. So the question is, why not retire early if you can? Well, I came across a list of the unspoken truths about early retirement that no one really talks about. Nolan, do you warn your clients about these? Are there still ways you can help them retire early despite these warnings?
When I first started thinking about this topic and I was thinking about the ugly truths of retirement, I was thinking, man, there probably can't be that many ugly truths about retirement, because isn't this what we all work for? Retirement, the golden years, the time that you get to go spend time with the kids, enjoy life, and get to the perfect retirement. And I guess it's, for me personally, it's because, I get to see so many clients that are out there enjoying life. I've got clients that are now coming back, that the weather's getting a little bit warmer. They've been telling me their stories of down south. I have other clients that are, taking their dream vacation this year. And, there's a lot of positives to retirement, but I guess part of it does go to getting to, and through some of the ugly truths about early retirement. So one of the things that I think when I think about early retirement is I think about a conversation that I had here on the radio a couple of months ago when Scott and I were talking about, one of the major reasons that people get forced into early retirement is because of an unexpected or unplanned for healthcare crisis, for a loved one. So it could be you, it could be a spouse, maybe a child that you're caring for, or things like that. There's steps that you can take now, I really say, to make sure that if we know that that's one of the biggest risks that faces folks being forced into early retirement, have that as part of your plan. Have you talked to your financial advisor of what that looks like in your situation? And if not, it should be part of it. The secondarily is, we had a conversation where we talked about on the radio a couple of months ago as well, where somebody who had unexpectedly lost their job. So, they were just forced into losing their job unexpectedly. And, here we are still, to me, on a scary fact of, if you look at, jobs and job offerings, if you look at inflation, if you look at, personal savings rates or people using buy now, pay later apps, we're slowly building up a little bit of, some economic worries that if all of a sudden the boss came in and said, well, I'm sorry, we had to eliminate your position and cut your job off, that could be another big impact and ugly truth about retirement. Is that a conversation that you've had with your financial professional? And if those two conversations are things that you haven't had, I think it's important to have those conversations. And when we have those conversations, some of the things that we're going to talk about is looking at what I would call early access to your nest egg. It really may be expensive. It's common to start utilizing retirement expenses earlier than anticipated if you retire or you get into one of those situations. But taking money from a retirement account could result in not only taxes, but it could also result in additional penalties, forcing you to drain your retirement account earlier than planned. So traditionally, when you think about a tax-deferred retirement account like a IRA, a traditional IRA, normally you have to wait until 59 and a half in order to take withdrawals from that account without paying a 10% early withdrawal penalty. In some plans, when you think about like 401ks or company-sponsored plans, you typically have to wait until the age 55. So accessing those plans early because of a job loss could result in additional taxes and penalties, actually compounding the problem. The other issue is if you retire before the age 65, when we look at the cost of healthcare can be extremely high. Medicare is normally going to start for somebody when they reach the age of 65 or, permanently retire. So what you end up with is this gap that says if you retire at 62, from 62 to 65, how are you going to fund your healthcare costs? Early retirees really need to budget carefully for those medical expenses because most employer sponsor plans is not going to be there and available for you. And you're going to be looking at, private health insurance. And if you go on to what is, quote, called the affordable health care, it may not be affordable in your situation. If you're within 5 years of retirement and you're thinking that you're going to retire before the age of 65, 5 years before retirement, you need to be talking to our office. You need to be talking to Scott, because what you want to do is you want to understand that the affordable health care is an income, not an asset test, meaning that when they're determining how much the cost is for your health insurance and or any credits that you're entitled to, it's going to be based upon countable income. And there are uncountable income sources and there's countable income sources. So why it's important is if you're going to retire before 65 is making sure that you have an understanding as far as what does your income level need to be countable, so you don't fall into Medicaid, but you also don't end up in a situation where you have high healthcare costs. There is a sweet spot that's out there of what your countable income level needs to be. And then if you need to have more money than what that is, then you work over the next 5 years or so to building up a bucket of money that would not be considered. Next, you want to think about the long life that you have ahead of you. Live a long, long life. Husband and wife, when they retire at 60 or 65, their life expectancy can be decades ahead of them. So you're going to want to make sure that your savings can last. If that, concern for a retiree is outliving their income, and you may have experienced some positive returns in the economy, the market over the last couple of years. And, the market has been fairly cooperative and been up. And I think over the long term, equities are still a great part of the portfolio for, somebody to have in retirement time as what I call their play check or their fund money account. Sometimes it's better off to pull from your investment accounts in the early years. Also, when you look at reliable income, you want to look at the amount of dividends and interest that your portfolio generates. If you, in the perfect world, could live off of the dividends and interest, then the ups and downs of the stock market aren't as impactful on your retirement success. When you're looking at your fixed investment accounts, if you're not going to get up and go to work every day, you need to make sure that all of your money is getting up and going to work as hard as possible. So doing that analysis of making sure that all of your accounts work as hard as possible is how it's going to help. When you think about it, we want to make your retirement like Saturday and a fun day every day, but we can help walk through some of these ugly truths of retirement and, again, help you check them off the list so you have a plan in place. So if some of those things are things that you haven't thought about and you're like, I need to think about those and get those in place, let's talk. Happy to help.
By all means, not trying to deter you from retiring. That's what we all aspire to do, again. And, if you could do so early, that's fine and great, quite frankly. You just want to make sure that you know all the variables going into it. The team at America's Retirement Headquarters, by developing that plan, can sit down with you and help you with the process. Here is how you get started. You can go to the website, arhq.com. You can also reach out, give a call, 419-794-3030. One last time, that's 419-794-3030. And want to thank you, as we always do, for joining us here on America's Retirement Headquarters. It is home of the Retirement Guys formula and America's Medicare Associates. Hope you have a great week ahead of you. Thanks so much for joining us here. Nolan, always grateful for the time. And as we wrap up, I want to leave you with the final word.
Yeah, spring is here. Happy to help you spring cleaning your finances. Just go to arhq.com, click on the events tab. Make sure you join us at some of our upcoming events. And remember, when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.